You're listening to Lender Lounge with Kevin Kim, a podcast dedicated to helping our listeners in the private lending industry grow, improve, and streamline their business. I'm Kevin Kim, partner at Fortran Law, the nation's largest private lending law firm. Join me as we chat with the best and brightest in private lending. They're eager to share their years of wisdom and best practices for lenders, brokers, borrowers, investors, and more. Subscribe to Lender Lounge on your favorite podcast platform and visit our website, fortranlaw.com, to learn more about how we can help you scale. Check out the episode summary below for other valuable resources. Hey guys, welcome to another episode of Lender Lounge with yours truly, Kevin Kim. We are in a new setup today. We've discovered this awesome studio down the street from our office, and so we are shooting live on location with these two fine gentlemen here. This is going to be a little bit of a different episode. We're going to have a much more lively discussion about the private lending industry at large, in particular in association with our home state of California, and also just talking in general as well. Before we start the episode, why don't you guys introduce yourself for our audience, and we'll get started.
All right. My name is Brad Laddusaw. I am with SNL Capital Group. We run a private lending company based out of the Oceanside area. I'm also president of the California Mortgage Association, which I'm sure we'll be touching on quite a bit today. Born and raised Southern California. Lending in our backyard is all we do, and advocacy on behalf of CMA in the industry is all that CMA does.
Yeah, my name is VandenBerg. I am vice president behind our president here, Brad. I'm with Talamar Financial. We've been in the private debt space for over 15 years. We are a private debt fund and fund loans throughout the state of California. So excited to be on set. This is a beautiful new set. I'm excited.
Isn't it great?
Yeah.
We shout out to Casey, my executive producer for the show, for locking this in. Now, Brock's been on the show before. You haven't. You have your own show, effectively.
I would not call it a show. We've talked about this a lot. I have, it came up again on the drive up. Like the whole real estate investor podcast scene has always kind of rubbed me the wrong way. But that's not what
it gets a little hokey. Yeah.
So I attended a conference. It was, I think, 2021, and there was a guy that was up on the stage giving advice on how to raise capital for his deals. He said,
a little bit,
you start a podcast, you get good people on your podcast to build credibility, and then you go take down a deal. And I'm like, holy shit, you said that live. Like, you're going to lose a lot of other people's money. But this is
fundamentals. Fundamentals are important in practice. And that's, you've been on the show before, Brock. And like the show, ordinarily, we're here to kind of get eyeballs and promotion for our clients and also for the firm and really kind of bring eyes to lenders who are really making waves and doing great things. Today, I kind of want to change up the narrative a little bit. Before we do that, I want to get some more history on your guys' companies because both of you guys are different. Mm-hmm. You're not the same kind of lender. You're not the same kind of business model. You're both south of Irvine. That's basically all you have in common. And we're all in CMA together. But just give a little history to your companies, a little bit of profile to your companies, and then we'll get started talking about kind of California at large.
Very good. So my business partner and I, Corey, we started SNL Capital Group, a little over 8 years ago.
It's already been 8 years?
Freaking flying by.
Oh, my goodness.
We follow what's called your traditional trustee-to-investor model. So we privately place our loans with high net worth individuals and family offices. We don't fractionalize our loans, which I think differentiates us from the rest. And we're able to push loan amounts up to $10 million loan amount sizes. We oversee the loan servicing of all of our loans, but we actually outsource that to a third party, liability purposes, and mainly trust accounting. I'm a CPA. I was in audit before I got into the loan business.
Right.
I think I'm a gentleman and a scholar, but I don't want to be sitting next to myself in an audit. So that is one of the main reasons why we outsource loan servicing.
And at that loan size, then that means you're also doing commercial real estate.
Yeah. So we do our target food groups, I like to call it 1 to 4 unit. Mm-hmm. So acquisition bridge for investment properties or income properties, as well as a fix and flip product. Mm-hmm. And then we have a large allocation for multifamily. I say about 5 to 50 units is our sweet spot. Mm-hmm. Industrial warehouse. And then we'll even do select office and some retail storefront across the state of California.
So commercial on retail and office, mostly multifamily, and then a big chunk in SFR.
Yeah, right. And I would say between the commercial food groups, multifamily, and industrial, we push those.
Are you guys California only?
California
only. Okay. Now, Brock, you've been on the show before, but a lot's changed. Yeah. You guys have grown a lot.
So, I started back in 2010, actually earlier than that, funding individual loans myself. Most of this was in the fix and flip space before that really, kind of blew up. And then we were on a individual trustee, similar platform. 2021, we connected. Actually, it was 2020. And we got to a point where we just had too many investors and too many transactions occurring where we felt that the mortgage fund model was a much more efficient platform to be lending off of. We could scale quicker. We could bring more investors in. So in 2020, we launched today what is called Talamar Income Fund. Most recent numbers, we've raised over $125 million for the fund. And
those serious numbers, man. In 5 years, that's fantastic.
Yeah, no, it's been a huge success story. Now, again, we were able to build off of our existing investor base from the trustee model, but it just goes to show you how deep the bench is for investors looking for a fixed income investment, especially in the real estate side.
Yeah,
So,
I mean, it's compared to what they're seeing out there in what's called private credit. I mean, it's much more conservative. Your first position loans. There's no weird unsecured commercial credit in the portfolio
that you're aware of.
So I mean, it goes to show you how deep. I mean, there's a lot of eyeballs. We get a lot of interest from an investor standpoint. I would say we're
a lot of them are
at
here,
this point
locally in California too.
Oh yeah, probably about 75% of our investors are in California.
That's a very rare story to see. Yeah, and your lending activities are what, residential only or
residential and commercial. So we really right now, as the fund grows, we've kind of had to morph in terms of just focused on larger loan sizes.
Yeah.
So really we're focused on the 1 to 10 million space.
Yeah.
Still SFR, still multifamily, commercial, retail, industrial, whatnot, kind of is our focal point.
It's funny because loan amounts in California have just skyrocketed since I started here, and compared to when I was a loan officer at a bank, it's back then a big loan was 1.5 million for anything kind of Class B, commercial real estate. Now, 10, 20 million is considered small. And California mostly?
California mostly. We'll do Western United States, but we know, the Southern California market, which is where the majority of our portfolio
you used to be like San Diego only, right?
Yeah. Oh, yeah.
And now you've kind of...
Now we've got, as we raise more and more capital, we have expanded our footprint.
Right. All right. So California, well, the one thing we all have in common is California. We're here. We're involved. You guys lend mostly. I would say concentration. You're all in California.
Only California.
You're still like 75, 80%. You said
even
more than that. So, California is a strange state. We've become an interesting state because as an attorney in the sector, it's
great for you.
It's great because we're just a highly regulated state, right? California is probably has the most complicated regulations for a private lender than any other state in the country, comparatively speaking. But the interesting part is also it's the largest market. And I would say the volume that the state produces in just private lending alone is probably makes the rest of the country pales in comparison. You cannot compare the numbers that are produced and the dollar amounts in the loans, right? So it's fascinating because there are times where I tell lenders, don't lend in California. Like I got guys from Texas looking for opportunity, guys in Nevada, guys in Florida. I'm looking for opportunity in California. I'm like, why would you subject yourself to this state?
And why? Because of the regulations?
Because of the regulations. Yeah. It's there. If you're a lender in Florida or in Texas, there's almost no licensing regulation. Foreclosure is relatively straightforward. There's not this big boogeyman. We have two boogeymen, right? So the perspective, but at the same time, there's like, I get it, Kevin, but we have to have it, right? And you look at any national shop in private lending, they all have California in their bench. And so I think this podcast is really important because people, while they dismiss California, they also have to recognize the importance of the state.
You touched on a couple of key points there, especially foreclosure process.
Oh my goodness, yeah.
But pre-COVID, grand scheme of things for how regulated California is, it was pretty, I don't like using the term fluid, but compared to some of these other judicial foreclosure states and regulation, there are stall tactics, but all in all, pretty efficient foreclosure process.
But it got pretty bad.
It got really bad real quick, which is something I always highlight. It's the legislative risk. When anyone asks me where I see most risk in the deals we do in California, it's on the legislative side because it changes quickly, and the laws they pass, sometimes they're retroactive. And you're like, well, I got these loans on the books already. Yeah. And it's
and not only that, but the cases. Yeah. The cases that come out. I mean, it's so frustrating being in California because it's like, what? Do they just not want?
Do they want us to leave?
They want that too. Yeah. I almost left. They not want us to lend here. They not want our money. Like it's the amount of tax revenue that can be produced right? Alone, just tax revenue alone. I mean, it's just fascinating. But like, I want you guys to kind of give the audience a little more information about the California Mortgage Association, your roles in the association. We've actually never really brought on an association per se. We plan on doing it. I think it diversifies the content for us. But CMA, unlike many of the associations that I see in private lending, it's very different in what it does. And I think you guys are the only groups that actually have had lobbyists for your entire existence. I mean, CMA has been around forever. So please give us some more color on CMA, your roles in the association, all that.
Yeah, so the California Mortgage Association is a nonprofit trade association that I like to say represents the asset-based private lending industry across the state of California. Major pillars: education, compliance, best practices, and advocacy. CMA is a nonprofit trade association. We have had lobbyists throughout the inception. CMA,
the mics.
The mics. So CMA formed from two associations back in the day. So we actually have a direct line to Sacramento. Our lobbyist, Mr. Mike Belote, of the recent battle we're currently having with AB 130, his name actually got dropped on the floor. And that does not happen. But that also shows the reach and the power that CMA does in making sure private lenders today operating in California still have an industry to lend in a decade from now. So when we're all long and gone and no longer in the business, the steps CMA has taken and currently doing, it's not going to guarantee it, but it's going to help to increase the chances that there is still a private lending industry here in the state of California.
And you're currently president?
I'm currently the president of the California Mortgage Association. And my biggest thing has just been doing this because CMA in the past has had a stereotype. We've talked about it.
We're going to get into it.
I'm ready. I'm looking forward to it. But something we've been trying to do, it's when you touched on the podcast that I've been doing, I call them interviews, but we're just trying to highlight members and service providers and attorneys in the space that allow all of our businesses to function. What a lot, I think, mortgage brokers and investors don't realize out there, even other lenders, if they had a bridge loan in the last decade, chances are they've worked with a CMA member. And the wins CMA has stacked up over the years, we just have never shared them. So we just want to, my biggest goal is just to increase visibility for CMA. And
I can't deny the impact. The impact has been meaningful over the past, for my career at the firm.
And let me highlight, I got involved with the CMA about 10 years ago. And I will tell you, it was the defining reason that I was able to scale my business. Because it is really the only association that is dedicated to California and educating its members on what, obviously upcoming regulations, what are the current rules, and then connecting you with other successful lenders in the marketplace. And so I think that really differentiates us from some of the other associations, as great as they are, but that kind of are on a more of a national footprint.
Yes.
And so that's why, as I think that's why we are around, and that's why we're continuing to grow, being out the fact that California by far is the largest lending market as well.
Right. And private lending has been the challenge CMA continues to face, I think all the associations continue to face, is private lending in and of itself is very fragmented, right? Even your business models alone, right? There are people that do not do your business model. They don't do trustee, they don't do commercial, they only do what we're calling now RTL, right? Fix and flip loans or construction loans, right? It's a funny phrase.
Yep.
Go ahead.
No, I'm just the rebranding that has gone through the private lenders industry. Some of it is great, but some of it, it's people ask me, I use this example all the time. I talk to a residential real estate agent or a broker, and they ask if I do hard money. I say, no, we do asset-based bridge loans. They're like, no, I need a hard money lender.
It's the same thing.
I go talk to a commercial mortgage broker. If I throw the H word out there, they'll hang up the phone. I say I'm an asset-based bridge lender. They're like, good, we don't use hard money. And I'm like, so when people ask what the difference is, I say they're marketing departments.
100%.
And I think it's the same thing for RTL, asset-based bridge,
RTL
credit,
is a new thing. It's a totally new thing. I think it's really Wall Street trying to figure out, like, how am I going to put this
under my umbrella
bucket of weird loans under a cool sounding abbreviation.
but I think also goes down to the capital source that they're raising money from and doing. They don't necessarily want to say they're cranking out all this high risk stuff and hard money. We're just doing higher risk and RTLs.
Well, the fascinating part is that hard money has a bad reputation to it, but like one of my favorite lenders have been around 20 years. They are super conservative. Their portfolio LTV is like 40%, and they lean into it, right? And if you ask Adam, their CEO, who we had on the show, like, why? He's like, well, that's what the borrowers call it. I'm like, yeah, it actually makes sense. Like, so it's like, there was this whole fight, like, I think about 5 years ago. Oh, we should not use this phraseology anymore. I'm like, kind of don't care. Because what do your borrowers call it? Because ultimately, you serve your borrowers and we serve you as a law firm. So like, ultimately, if the borrower calls it hard money,
go with it.
It's hard money.
They sign the same set of loan documents.
It's the same loan documents, it's the same laws, it's the same LTV.
And it's not like your hard money in 1975 or Cousin Vinny's coming after you if you miss a payment.
Exactly. It's not 18 and 6, and it's not that, right? So the funny part though is that, yeah, since the market has changed so much over the past even 5 years, it's insane, right? And so you have, since COVID especially, the predictions around commoditization and concentration to some degree have happened. You have shops that are exclusively touching only things that are residential. So SFR 1 to 4, fix and flip construction. And then that now with that in the past 2 years, that becoming its own overly commoditized product moving into multifamily. And so, but at the same time, CMA has always been a very diverse set of members. I mean, I think the longest time, for as long as I've been involved, and at least over 10 years now, the majority of people there didn't just do SFR.
No, I'd almost say we use the word property agnostic.
Yeah.
I mean, they're very opportunistic. They look at the opportunity, the lending request, and then they kind of work around that. And I think that really works well when you're kind of on a trustee model where you can find individual investors to be lending for that asset class.
Right.
And that's, so you could be much more flexible from that standpoint versus kind of what you've seen now. And you talk about commoditization of the fix and flip space. I mean, your credit box is this, and you got to underwrite to that.
Yeah.
And, when I think of hard money, I'm thinking, again, the credit box is this, right? You're trying to figure out what's going to work for you, the lender, and you, the borrower as well.
It's truly asset based.
Yeah,
it's asset. Mindset is asset first, and then back in.
But still real estate.
Yeah, but real estate asset. So it's to your point.
I'm making SBA loans over here. Yeah.
No, but what to your point is just fascinating. It's you have consumer bridge lenders, construction lenders, land lenders, ag lenders, cannabis lenders.
That's been the cool part about CMA is that you see a diverse group of lenders in the room. I mean, the first agricultural lender since I left the bank I met was at CMA, and there's a few guys that we still work with that are focused on ag. The interesting thing though is like, okay, so if that's the case, though, if that's the fact pattern we're presented with, the market that we see today on national footprint, because California is its own kind of version of the national footprint, because every major shop is here, both commercial and residential. They're all lending in California. So then you have this weird dynamic. You have the subset of the industry that just does residential. You have a subset of the industry that just does commercial, and then you have guys that look like you guys that do both, right? A lot of the members, and then you have the guys that do consumer stuff. Right, but then the non-QM guys don't really participate in CMA. So it's kind of like, what's the mission on CMA's perspective? Like, are we trying to capture the entire audience, or are we trying to capture just kind of like the guys that just do bridge lending? That's been kind of the question mark in my head.
I think you can capture all of it.
Yeah.
Because I think, again, California is on its own island.
Yeah.
And I think that there are so many changes legislatively that, even if you are lending on a national footprint, you can still be, and it's very important to be involved in the CMA because you need to know what's going on in California, your biggest market.
Yeah.
So if I would tell any lender, even outside of California or is on a national footprint, that CMA plays a critical role in educating you and your team as to kind of what is going on in the state of California.
And I don't think it's specific to just lenders. Mm-hmm. It's also your mortgage brokers, even your investment sales agents and brokers, because I like to say bridge is bridge, baby. Yeah. It's you need to close in sub 14 days on your asset. You got a 1031 on the line or a distressed property, perm lender dragging their feet. Chances are, like I mentioned earlier, if you're using a bridge loan, chances are that they're involved with CMA.
Yeah.
So why not just come and network with all the asset-based bridge lenders that touch all the food groups in the state of California, but on the legislative risk side and compliance? You and I have talked shop damn near every single conference.
Yeah, we have to.
Over drinks.
Yeah,
but what I think differentiates CMA once you're actually at a conference or mixers that we have, a lot of our members and attorneys, everyone I don't like saying lets their guard down, but they're willing to talk shop, trade war stories, and share insight on a deal that maybe went sideways 7 years ago, and they implemented a change in their underwriting to catch that going forward. So there's little things like that are picked up that I think are invaluable. It's not about how much volume we're doing. It's, hey, what are we doing to make sure we're still going to be here in a decade?
And I wanted to also highlight something that was funny. A couple of years back, I had a chance to listen to you at a conference, and you were doing a Q&A session about, lenders could ask you various questions. And I think every question that came up was regarding California. You actually finally came up and said, hey, everybody, I'm going to, let's not just ask questions about California, being that this is a national conference, that this was a national conference. So it goes to show you how much focus there is in California and how many questions people have about what's going on in California.
Well, that's the funny part, right? So that's how I kind of rationalize it in my head. If we exclude consumer from the conversation really quick and look at if you're doing business purpose 1 to 4, or you're doing commercial real estate financing, whether, I don't care if it's short-term, long-term, it doesn't matter, right?
Name it.
Licensing, foreclosure, best practices in underwriting.
Servicing.
Servicing. Oh my God, servicing is so complicated in this state. So like all of those things you can learn from. You can get value, not just learn in seminars and the sit-downs, but like one of the things that I asked a national lender, like, hey, why don't you, like not the actual CEO, like, why don't you send your GC? Because she keeps asking us all these California questions. Like, I'm billing you at $800 an hour. Just send her to the seminar because she can sit down with. I mean, I always joke about Uncle Chuck, but literally, if you want to learn something, sit down with Uncle Chuck. He doesn't come anymore, but like when he was coming around, like guys like that, and you can actually learn a ton just by listening to him for 15 minutes gab on about what he's been through.
And his willingness to share.
100%.
I think that's what's really highlights I think one of the biggest value adds for me over the years. Guy got involved with CMA around the same time, 2014. And I call it the old guard versus the new guard. And you have the old guard they've been through cycles. And I think that shows how resilient this industry is. I mean, we have some members that have been lending since the 70s. We have one company that is got to be pushing 5th generation. They started in the 20s. And then you have others in the 50s, but they've gone through many cycles, and they share what has worked and what hasn't, and some of the stuff they dodge. And I think that I always like asking those questions, because they like to just share it, and it's not about how great they are. It's about like
it all comes and repeat itself, right? The same problems we saw 20 years ago are coming back: regulatory overreach and how do you combat that, right? And that's another part is like our clients are always like, I just don't get it. Like even guys who've been here for 15 years, they are completely misconstruing what the regs are. And so it's like, well, as your lawyer, I can tell you this all the time, but you probably should find practitioners to talk to as well.
Yep. And someone that's potentially gone through an audit. I mean, it's not if, it's when. You're going to go through an audit if you're doing business.
We were at CMA a couple years ago. We were literally at the welcome reception, and they were just exchanging what this examiner said versus that examiner said over all the. You were in there. I think you were at that round, and we were just talking about, man, this is what I'm going through in audit, and this is what I'm going through. I can't say that because I'm counsel and I have attorney-client privilege, but you guys can easily share ideas and share war stories and ask questions to each other. I think that's more valuable than me sitting there like, because my reaction is going to be, well, we have two choices. We have to comply or we sue them. At this point, that's kind of all we can do.
It's theoretical versus realistic.
100%.
And that's what we talk about.
Right.
And, I think one of the great panels that they host at the CMA events is a legislative session. And they go through all the regulations that have changed.
Yeah.
And then you can get up and ask questions to those on the panel about how does that impact your business.
Right.
And it goes a long way to adjusting how you are doing your business here in the state of California. And I love that panel. I think it's a great panel. And there's no way you'd be able to gather that information
or interpret
anywhere else on site or interpret it.
Yeah, we have and even when we do the private money basics, we started a couple years ago.
Yeah,
and that's where I think
that's
what Nima's awesome. And we dive in heavy on title insurance and all that. And he's always there's how the law, like how it's written, and here's how it actually happens. And it's again, your guys, I can't speak highly enough of your willingness to just share and add value to the industry, because it's not It's not easy. It all takes time, but
it blows up in our face a lot because what happens is we'll put out education, and then our competitors will take that who don't participate in CMA, and they'll basically use that against us. I'm like, hey, no, hold on,
right? And
that's like a quarter of what actually needs to be taught. But we're giving as much.
It's a starting point. It's a starting point. Here are a list, and any panel that we try and I moderate. Doesn't matter the association. Yeah. It's like, this is not 100% exactly how to do everything. Here are the potential landmines, and here's a list of questions. You go talk to your legal counsel about or your service provider and be like, hey, I need to make sure I'm covered here or covered here. And then also CMAs, I think, great relationship we have with the DRE.
I was really impressed by that this past round because like the DRE is the big boogeyman in California. We always joke about like there's two boogeymen in California, and one of them is scarier than the other, and the DRE is that boogeyman. But we just got back from Monterey. The CMA just held their, is it the spring seminar? That was the summer.
That was
fall
the
seminar?
Yeah.
Fall seminar, fall conference. This guy brings up the commissioner of the DRE on stage, and I'm like, and she's so nice.
She's awesome. She is
so
awesome.
Nice.
Right.
and you were actually going back and forth on some regulatory stuff that my entire career here at the firm, I've been trying to get an answer on. And it's like, thank God you guys have opened up the channel for us to ask, because unlike the DFPI, the DRE is a lot harder to get answers from. And I don't know if I think it's really not intentional on their part, just bureaucracy and all that stuff.
Yeah. They're massive. And it's, so a little story about Chica Sundquist, the DRE commissioner. So when the fires hit Southern California, I received a cold call from someone. It's like 6:30, 6:45 at night. And I was like, I don't want to pick up this phone. I'm trying to get out of here. I got 2 kids at home. I pick it up, and it was a DRE commissioner.
Right.
And she was just calling to see how membership was doing, what the exposure was like with the Los Angeles fires, get our input as an association, how we think things might play out from insurance, recovery. But she was taking notes. You could hear her taking notes because she was going to escalate it to other departments.
That's great.
And it was like all hands on deck. And she did not need to call us or call me and do that. And she genuinely cares about the industry. And that's why I was excited to have her come, because I wanted to not just have her come and give a presentation like some others in the past. I was like, let's have a conversation.
Yeah, that was good.
You're a real person, and let's get a better understanding how it works behind the scenes at the DRE on hierarchies, to where if you are going through a DRE audit, what can I ask to escalate? Or is it just a standstill here? And then she highlighted, which I thought was, I had no idea, that she can't really opine directly on a case directly with your attorney because she's not an investigator. She is now the commissioner. But again, another value of the CMA, and I'm not saying all of you to flood me with your stuff in emails, but if there's something that has gone through the channels that we can document, might be a misinterpretation from the auditors, because the statutes are very convoluted and confusing and vague, there is a channel to the commissioner.
And that's more than we can ask for. That's been the challenge in California, is that the DRE is the only way we have precedence is through audit. And we like to avoid audit if we can, right? So,
and that's a good point. I mean, let's talk about what happens to get to an audit. Let's focus on what we can do today.
Yeah, exactly.
So that we don't get audited,
or an examation, God forbid.
Or an examination, and if it's from accounting, or it's from trust fund accounting, to if you're selling notes off, if you're doing that correctly, making sure that you have the right documentation in place. I mean, that is imperative that you have that set up.
And that's the thing, is that what I've been telling people for a long time, that guys, the national industry, guys, you're all buying buyers, you're all buying in California. You're all lending in California. You're all brokering in California. Like, whether you come, I don't care if you come CEO, but like maybe send your GC or chief operating officer,
head of compliance,
bring them on over, because they're going to gain a lot out of this, right? It's not necessarily just networking like everything else, and that's why we're so heavily involved. Like, we don't get involved as deep in education. The only two we get really that deep with are you guys and AAPL. And that's because AAPL is national education. You guys are local education. But at the same time, we know the national landscape. Texas doesn't have one of these. Florida doesn't have one of these. Like, it doesn't exist.
Surprising.
Well, they don't have as many regulations. I mean, we always joke, like, Texas has, the number of laws they have compared to California. But at the same time, like, it's complicated. Foreclosure is tricky in Texas if you're uneducated to the industry, And same thing in Florida. And so like,
and then Texas, I just found, we don't do deals in Texas, but I just found out like trying to find your own sales comps, they don't list the sales price. So how heavily regulated California is, I always like to say, I could figure out exactly who I'm working with in about 45 seconds.
Right. There are some pros that come out of these legislation. But it's and more so on the licensing. It's a pain in the ass. Let's call a spade. But it's some inefficiencies and different licenses for doing the same thing. I know when I sat down with Nima, we were having a freaking crack up over that. It's lenders from New York coming here or vice. That's the thing is that's probably on the licensing side of what we do. That's probably like Jen and I do license applications for private lenders, and like 30% of the conversations are in general, and probably 70% about California specific is like, help me understand the landscape, right? And even the big national shops, they're just confused. And you have a lot of lenders that are East Coast lenders that lend here because they're national, and they're just flabbergasted by how complicated it is here. And what's just kind of interesting though is as they evolve through it, the CEO started to become, oh, I get it now, and they know more than their compliance officer.
And it's like that's sometimes I present and someone's like, oh, how long have you been practicing law? It's like, no, I just talked to a lot of attorneys. Because I need
to lend here in California, you actually almost have to have. There are some lenders as CMA that have a better understanding of the DRE than I do, and it's fascinating because it's just they've been audited so many times, and there's the nuance, and then there's the practical nuance, right? The legal nuance we understand better. The practical nuance they understand a lot better.
And that legal nuance, I don't think it's touched on enough.
No, it doesn't.
That it's just saying you have a real estate attorney in the state of California is not enough.
No.
That attorney needs to be hyper-focused.
We had this come up. A big commercial shop. They're up in LA. Their servicer, their big national servicer, was mistaken that they did not need a Department of Real Estate license in California to service loans for other people. I'm like,
wow.
Who told you that? It's a big law firm. Some very famous big law firm in real estate. I'm like, oh, that's why. There are big law firms that know this stuff, but like you didn't ask the right questions. And it sucks, but like it's going to be solved. But like those kind of are worst case scenarios for us because we know how aggressive the regulators can get here if you're in blatant noncompliance.
I call it the lights out. DRE comes in and you are not following those regulations, it's lights out.
Right. Well, I'd like to ask something in a similar vein. It's, okay, we've gotten into how important CMA is on the regulatory and the advocacy front. But if I talk to lenders about CMA and I bring this up, hey, your COO, your head of compliance should come out. Like, well, we give it a shot. It's kind of small. The usual complaints. I hear it's too small. It's a lot of these guys are doing commercial or consumer. Isn't that a consumer show? So I'd like to be able to dispel some of those issues because I personally think that CMA can provide a ton of value to the national audience because of all the different issues that you have been talking about today. But there's a weird resistance, and I don't understand. I can't put my finger on it, but there's a weird resistance. Because like, for example, number one private lender on hard money, on RTL, Kiavi, right? Mm-hmm. They have a chief compliance officer. They could easily come down and come to the San Diego show or the Monterey show or whatever, or if we do it in the Bay Area, they're in the Bay Area, they could easily come out. They know about it because I brought it up before. They're like, but the marketing team, for some reason, doesn't really see the need to go to it, or they don't really understand the need to go to it.
Yeah, and I think that's something we've been working on, changing heavily the last year and a half, is messaging and visibility for CMA and the value add it brings. I have said this countless times. I did not join CMA to quadruple my business. I joined CMA to increase the chances of still being in business 10 years from now. Mm-hmm. And that is, I think, again, maybe a misinterpretation on messaging. Mm-hmm. I pretty much exclusively refer my deals to CMA members, just because I know that their shops, higher probability, their shops are set up correctly on the compliance side, processes are in line, they're lined up with the right attorneys and service providers behind the scenes, and I know they perform. But it's more so on sharing that. It's like you're probably not going to send your head origination, whoever heads up originations for fix and flip loans to come to a CMA conference. But the compliance officer, an underwriter, the nuances in the California private lending laws
Mm-hmm.
are very heavily open for interpretation at times. And I would challenge some, it doesn't matter the lender, whether they're institutional or not, review your RTL loans and you'll be freaking shocked. You might have an oh shit moment of how many actual consumer loans you might have on the books just based on disclosures on the front end.
Yeah.
And it doesn't take 100 loans to put you in a tough spot with a regulator or someone filing a complaint. It just takes really one.
Well,
and you don't want to be the next.
At the national scale, you're also making reps and warranties on all your contracts that you're in compliance with all relevant laws and servicing and origination and all. Like, it's a serious risk. Like the well-heeled shops will come to me, Kevin, I have this clause in the MLP coming up. I'm a little bit nervous about this. Can you take a look at everything? I'm like, yeah, sure, no problem. That's a major concern for these guys. And so you guys are worried, bringing regulatory risk up. That's a factor. But the challenging issue on my end with these guys has always been like, I think that the executives are more concentrated on growth, right? And volume and numbers and profitability. Maybe they shouldn't be at the show, but maybe their head of compliance should be at the show.
Well, let's not discount that, because I'd also say it's a good opportunity to get a feel for where the market is going. I mean, when you go to these events, you sit down and I'll talk to Brad about kind of what am I seeing in the marketplace, where a lot of these large shops are focused on SFR, small multifamily, especially on the RTL side. And you may not on a broad level understand what is going on specific in certain submarkets of California. I mean, we are seeing home values starting to stagnate. And how does that impact your underwriting if you're just looking at it at a macro level from the US, you're not looking at what's going specific in Los Angeles, the Bay Area, San Diego. You're going to be missing out on a lot of probably decisions that you're going to make on the short term on what your underwriting is going to happen.
But, I mean, even on specific, like right now, germane topics like the fire issue, like it's constantly evolving. And I didn't even know. I was surprised. I got a lot of good intel when I was in Monterey together. When we were together, I had no idea what was going on, like to that degree.
In terms of what?
The redevelopment. Like it's not happening.
The non-existence.
And why, right? And so that level of intel gathering is important because people are trying to position themselves. They don't know what's going on the ground.
No, and then even just with the fires or the nuances of navigating the city of Los Angeles, all the different departments there. Yeah. So your ground up construction deal in Los Angeles is completely different than what you're going to be doing, let's say in Salinas, California, or down in San Diego. And you're only going to get that from talking to lenders that actually have exposure to that market.
Or let's talk about ADUs. I mean, ADUs, that's a whole topic we could talk for an hour.
I mean, you San Diego people are like the experts of the ADU.
But like San Diego is taken over by ADU projects. But if you would actually listen to somebody on the ground, it's not all daisies right now. I mean, there is such a potential for oversupply of these little micro ADU units. But again, if you're not at these events to understand
back to regulatory, you don't set it up right, you've got a consumer loan in your books. And you have to structure it correctly. Yeah. I mean, the local guys in San Diego have really perfected it, but like anywhere else in the country, because that fad will spread, right? Any other city that faces density problems, that fad is gonna spread. We're already hearing about it on the East Coast, right? So you guys should understand, like this is what we're seeing on the ground here. You don't think that your local legislature is gonna follow suit, right? So that's really important. And zoning rights and all that kind of stuff too.
Now, don't get me wrong. There's huge opportunity. I mean, a lot of these cities have really now refocused and said, okay, we're going to loosen up our zoning allowances here. And that opens up huge opportunity for lenders. But you have to understand what that means.
Yeah.
And I've often said that I think the ADU play is going to bury more investors and it's going to create successful ones. If you're looking for purely value add play on ADUs, even with cities loosening things up, they're all overworked and underpaid. They don't have the manpower to get these applications through and review.
Yeah.
So if you're doing a high leverage value add deal as a lender and it's a 12, 18-month loan, I'm hoping that borrower is actually going to be able to start breaking ground within 12 to 18 months, let alone finish the project.
Yeah. So these perspectives are important, right? Because what I like about CMA is the majority of people in that room are remarkably conservative lenders. And that perspective is important because an underwriter, they can, whether the business follows these guidelines or not, having that part, because the business is in their ear constantly, which is telling them to push leverage, push deal flow. They have to have a balancing sounding board on the compliance side.
And I think you make a good point. You say a lot of conservative underwriters and lenders, but I've talked to some institutional guys. I love talking to them because I think there's a lot that CMA could learn from processes, infrastructure, and all that. But then also I tell them some of the deals we do on the commercial side, and they're, why the fuck would you do that? That's risky. Yeah. But it's beauty is in the eye of the beholder.
They don't understand commercial. That's also it too.
But that's where I'm getting at. There's opportunity everywhere. No matter what type of shop or no matter how you're structured, there are inefficiencies in everyone's processes.
100%.
There's inefficiencies in mine.
Well, it's bias too, right? Yeah. It's confirmation bias in a lot of ways. A lot of the RTL shops, they could easily do, for example, 20-unit multifamily. They won't touch it, right? Because it exceeds whatever buy box they've set up. That is informed by the institutions and their credit facilities and whatever. And that creates confirmation bias. Oh, it's risky. Well, no, it's not any more risky.
You just don't have money for it. Let's call it a spade a spade.
Well, that too. Yeah. You don't have capital for it. But secondarily, like, you just don't know how to underwrite it. It's a different underwrite. You need to have a different mindset in underwriting those kinds of assets, true multifamily, as opposed to a 5-unit, 10-unit project.
And it's about scalability as well. How can we automate our processes to get good?
That's one thing. Yeah. So that's a good segue. So CMA also has this reputation of being a lot of the old guard. You mentioned that earlier, old guard, new guard, right? As part of, we're the young guys at CMA, right? Yeah. Right? We're the young guys at CMA. And this is the challenging question is like, okay, I really believe in what CMA is doing. I want it to be there for another 50 to 100 years. I don't know that it's going to continue if we don't get new blood in, right? And so the institutional shops, the guys are in California but not showing up. They're not institutional by any means. They're just not showing up. Like, how do we get them to show up? How do we get them to participate? Because that will drive new membership. That will drive new engagement. And we'll have those discussions about how to improve your business. We don't do a lot of business talk. We don't do a lot of like business optimization talk at CMA. Like, I would love to see more of that too. But how do we do that? How do we achieve that? And I think this is the only way I know how, right? So,
and exactly what I was going to say. That's why it takes energy, confidence, and someone that's just willing to call it how they see it. And I think that's...
Well, I think you've done a wonderful job too, Shafiq, prior to yourself as well. And I want to highlight one of the things is we're just talking about these pop-up events that you've been hosting. And we used to have, the CMA would have 4 events per year, and you'd all go to those events.
Yeah. Right? But they were the only 4.
They were the only 4.
So it wasn't taxing.
Sure, you're right.
When everyone just lent in their backyard, it was relatively easy.
Well, there's no nationwide lending.
COVID hit. We had to shut down the events, but we brought them back, and now we've got 2 core events per year, one in Northern California and one in Southern California. But now we're doing these pop-up events, and they're great events. They're a couple hours. You go and network with other CMA members. We invite vendors and other brokers from the industry to these events, and it's been a boom for the CMA.
Yeah, in membership, and it's just, I think it's just going back to the basics with CMA: education, compliance, best practices, and advocacy. I think there is a drive to education currently and compliance. And I do think you're probably,
Our surveys tell us that too. We're getting a lot of feedback right now.
So again, your private money basics that you hosted. We had how many people at that event?
So we cap it at 60, and we have 60.
We had 60 people at that event, and it was basics. We're going straight down to the basics. Yeah. What is private lending? How do you not get in trouble? How do you grow your business? Yeah. And it was a huge success. So those kind of events have attracted, which is why we've seen an increase in membership over
I don't deny the quality of the education.
Yeah, but it's more so messaging, right? And how do we continue the growth? And I think if you went to a conference in Monterey versus a conference 5 years ago, I think you would grown, but the faces in the room have also changed. There are new lending companies that have popped up that are coming through. I would say the energy and the tone in the room is completely different. Yeah. It's a lot more inviting type experience versus feeling like you're going to walk in and you're the redheaded stepchild.
A little bit.
I don't know if I could say that.
Well, I think that it's a different environment. People are more open-minded to kind of what you consider the current landscape of the market, right? So like Ryan Saylor from DIA came out. It was nice because he was surprised. Like, he's like, a lot of these guys already do DSCR. They just don't know it. We could do really well here. I'm like, yes.
And that's the outreach that I think it's not only on Brock, myself, or you to share the value CMA brings. It's also membership.
Correct.
reaching out? Where are you going for your meat and potatoes and vegetables? Where are you also going to expand your lender network in the bridge space? DSCR coming. So I personally think it is just a messaging and delivery type thing where CMA is a nonprofit. We don't have a marketing budget or team like that. Whereas some other conferences where they might have a team exclusively for marketing and promotion and all that. CMA, our committees are made up of members that are volunteering their time.
No, I get that.
Yeah. So,
I
think that's the challenge we've had because we're all running our own businesses. Yeah. And it's a thankless thing.
It's a volunteer thing for sure.
Yeah. But again, I think that's the value add. We are running our own businesses and we can bring in our own inputs as to what we're seeing in the market.
Yeah.
And again, from a lending perspective, everybody has a little different niche that they're coming into the market with. The other thing I wanted to highlight is that we are, reinventing the fund manager committee. And so this is where we bring in fund managers from within California together and having an open discussion about what is going on in the industry. We bring vendors like yourself to come in and explain what is going on in the marketplace. And this is a great opportunity for people that are not only looking to launch a mortgage fund, but currently in a mortgage fund and trying to figure out where to go in today's marketplace, especially with the advent of institutional capital. Where is the opportunity? I think there's this misconception that because institutional capital has come in, that the opportunity has gotten slimmer. That's far from the case.
No.
It's actually grown.
No, yeah.
Right? Now this idea of, we use the term hard money. Forget the notion. It's an industry now. It's a private lending industry. We've taken market share from conventional banks, and we're going to fill that void. And there's the opportunity there. So I would say that if you want to find opportunity, you want to talk to people like ourselves about what's going on in the industry, the CMA is a great platform to do that.
And not to plug Ryan Saylor with Dia, but I thought he had the funniest line in Monterey when he was talking about, he's like, some people are just so against the institutional money. And I asked him, do you have leverage on your fund?
Yeah.
You are an institutional.
Do you work with a bank?
I thought I was fucking rolling in the crowd.
Well,
I
that's
thought
the
that was
funny part.
but it's true.
There's a resistance. There's a semi-resistance to the institutional, I guess you call it, counterparties in the sector. Because I remember when a lot of the institutional guys that were popping up in 14, 15, 16 started to show up. And there was this resistance to them. They shouldn't be here. They're bad people, that kind of stuff. And I mean, that pushed a lot of people away. So this inclusiveness is important, right? Getting people more involved is important.
I call it shaking hands and kissing babies and talking shop.
But I'll tell you, one of the things I'll tell you is that if you look at the other associations, the bigger shops, they eat it up getting involved. So there has to be a way for them to get involved. They really, especially on the advocacy, and also like kind of education, they really like getting involved.
Because the other big one on the advocacy side, I would say, what is it? The NPLA is the one that's heavily involved on that.
They do some stuff more. They're East Coast concentrated.
But what other associations are more big on
the local stuff in California?
I just don't know.
In California specifically, the only association that works on legislative besides you guys is CMBA.
Yeah, and we talked.
APL will support anything that CMBA and CMA does. I think we've done some stuff together with CMA and APL in conjunction with CMBA. California only stuff that's germane to hard money lenders, private lenders. CMA is the only one that does. Here's the question though, is if I'm, kind of a regional shop, right? And I really like this stuff. I want to get involved with it because I think it's important for my business. There's got to be a way to get involved. Getting involved, so volunteer, right? So it's a volunteer program. They need to know the pathways to get involved without too much hoopla and red tape.
Yeah.
They want to get involved. Help me get involved, right? That means the world to these guys. And so getting it, and it does for us too. Yeah. Getting involved is something that we really want to do. Not only because we think that it also helps with the messaging, but the challenge is also like engagement. I like that. I see it all the time on the other associations. They get really engaged because they're involved. Mm-hmm. So like if we can get we can get Ryan involved, right? Or the big foreclosure trustees or the big servicers involved. People would get more excited to be part of the association.
I agree wholeheartedly on that. And again, it starts to come into a pop-up mixer and talking to people that are in the industry that are also involved with CMA. It's like, get everyone out from behind the logo. Like, let's just have a conversation. And it also, I still talk to people today that have been involved for CMA for a number of years. And they don't know we're a nonprofit trade association.
No.
They don't know we have a lobbyist.
They don't know our involvement.
They don't know and that comes to sharing our wins. Like in the past, we just didn't, CMA didn't like to share their wins. They never did. But it's like here's what's currently going on. Here's the battle we're up against.
In today's world, if you don't promote it,
but it's also to your point that you just touched on messaging and your firm's involvement and growing involvement. We greatly appreciate it, and it's the shit flows downstream. A lot of times it starts in California.
It does.
And we have stuff currently going on and has been going on where some's been resolved, other issues have not, to where, hey, if it picks up steam here in California, it may start trickling to some of these other markets.
Yeah, and I'll give our audience an example. Like there's this huge sub-industry in residential real estate called HECs, right? Home equity contracts. California will likely be the first state that will deem that to be a loan. Do you not think the rest of the country will deem that to be a loan? Eventually, they're going to follow suit. We saw the same thing in factoring, right? So then the nice part is that other states didn't follow suit in factoring. but HEC is different because it has to do with someone's house. And so like it's a huge market and there's a lot of activity in that market. But California is the wobbler state they're all kind of scared of. And if they make the call that it is a loan, well, here we go, right? And so that's the stuff I always warn everyone about. Like what you're thinking about, you're in a sweet spot right now in Texas, but will Texas all of a sudden make a left turn like Nevada did if another crisis comes? Right? Nevada's it used to be a red state. They made a left turn because of the 2008 recession. If another recession comes, I don't think that these red states will stay in this whole free, no regulatory arrangement. And I hope you plan on being around for another 20 years. So.
Not to go down the political landscape too much, we'll start drinking way too early for today. But it's the power of the dollar. I mean, it's
and that actually is an interesting question. Has CMA ever done anything like that with like fundraisers or anything like that for politicians
so CMA's PAC is designed for that, for outreach to our legislators, promote things like that. But it's when your lobby day is a big thing that we did.
Yeah.
But if you go
tell me more about that because I don't know that. I've never been involved with lobby day. I think our audience would love to hear about that.
Yeah, Nima could make it up. Steve made it up, and he wants to cruise again. So in the past, CMA had lobby day. This is pre-COVID.
Yeah.
And it was a big outing where we would get a lot of members. We fly up to Sacramento. We schedule anywhere from 15 to 20 meetings, and we sit down with the legislators and their staff and discuss a couple pressing items. Mike Belote, our lobbyist, his office is up there right by the Capitol building. So we have lunch at his office first. He's like, here are our pressing items. Here's our agenda. Here's things you cannot discuss with legislators in their office. Don't discuss fundraising. No fly zone there. But then we go and sit down, and what I was surprised about is they genuinely wanted to listen. Some of the staff, you could tell, like, hey, I'm forced to be here. But for the most part, they're like, this will negatively impact the industry because of X, Y, Z. We did that again this past May. Odell Murray brought it up. We teamed up with the United Trustees Association.
Oh, great.
And we formed a subcommittee with CMA to bring this back with some vengeance going into next year, or I should say momentum.
It's great.
And I want to have 40 to 50 members up there. And you don't necessarily need to be just a member of CMA. It's like if you're an industry participant, come up with us. We'll meet at our lobbyist's office before. Then we go sit down with these meetings just to educate them because they see us as one big lending industry. They see us as potentially Bank of America, Wells Fargo, the big bad lenders, which we're not. We're just a lot of small business owners, lenders that are driving value, providing liquidity.
And I went there for my first time. You had suggested I go up, and the takeaway I had was this. Number one, you're right. They kind of lump us into one big organization.
So there's ignorance on the hill as well.
So the next thing,
since we're going up there next year, I would say it's lack of understanding.
They don't know. They don't know the industry we are.
They don't know what they don't know.
I don't want to say. So the second thing is, we sat down with a lot of these legislators, and they listened and they asked great questions. They're pummeled with thousands of pieces of legislation every year. So there's no way they can just focus on our piece of legislation. But they're willing to listen, and they ask great questions. And I was blown away by how willing they were to understand our side of the industry. And maybe it doesn't go our way, but you're out there educating them and hoping that if any new legislation comes up, that they'll see it our way.
And some of those, and it's just like I said, it's getting out from behind the logo. And some of these bills, they put a lot of reliance on their staff to tell them what's in there. And their staff just may not know what's on page 95 of a 250-page bill that could potentially impact a sector of the market that will have a ripple effect. So Lobby Day plays a very important role with that. And we're not the only one that has a Lobby Day. CMBA, I sat down with Cody with Slat, heavily involved with CMBA. And that's what we're talking about. It's just doing more of
getting
that.
those being with assemblymen.
And if you're not doing it, somebody else is.
Correct.
On the flip side of what what you're trying to accomplish.
Is there any thought with the advocacy and with the lobbyists to do any kind of political supporting, actually picking candidates and fundraising for them?
That I cannot confidently answer that question right now on how that would actually play out. Yeah,
it's tough in California.
So, and I don't even know what the do's and don'ts are.
There's a lot of California has 10x the rules on lobbying and fundraising that the federal government
and that's
does.
what the PAC is for, to kind of support certain legislators that agree with kind of pro-business, if you want to call it that, in the state. But then you also have what CMA used to do in the past, and this is more pre-COVID. You had advocacy is not just going up to Lobby Day for one day. It's if you have your local legislator is having an event, you go to those events, or you invite them to a fundraiser that you put on behalf of the industry, because they are in the people business just like we are, and they only know what they.
And that's a great point. I mean, we were writing. I wrote a couple of letters out to my legislators, and I actually got some responses back from them that they received it, that they understood, and that they felt that we had a good position. So this idea that our legislators are not listening to us is a fallacy. I mean, they are, and they want to hear from you. So my recommendation is reach out. If that's an email, through their website, a letter, going out to this advocacy day. It's important to get involved because it impacts you.
Yeah, and it's similar to if you're talking to a borrower or let's say a title underwriter, you're trying to get your title policy in place. You're not going to go hostile at them with something, but you need to have a professional, open, educated dialogue, and they're happy to have it.
And then with getting involved with all that stuff, I think one of the things, I'm not entirely sure how this works. Let's say someone's listening and they want to get involved. How do they get involved?
Shoot me an email.
Okay.
No, it's literally as simple as that. To get involved, you have to be involved, as cliche as that sounds.
Become a member.
Yeah. So it would start with becoming a member, but it starts with a call first.
Yeah.
Because I'm not here to pitch CMA. It's not for everyone. It's not for every company. I just share what I've gotten out of it over the last decade. Yeah. And it works for some, not for others. But you also don't need to be a CMA member to come to conferences, to come to mixers. But there are value adds of being a member, and getting involved just starts with when applying for membership. And then just talking to me or any of the committee members. That you go to our website and you'll see all the different committees, and you can reach out and say, hey, I'd like to get involved with XYZ committee. And then it's reach out to the committee chair, and if there's room for the committee, get them on. And a lot of members will rotate off of committees just for lack of time.
And I think for anybody that just kind of signs up for an organization, going to your first event can be daunting. You don't know anybody there. And I think we do a very good job of making those introductions. A lot of our panels are very interactive. So you can ask questions, you can respond, you can share stories and share ideas. These pop-up events are wonderful events to show up if you're not involved already, just to get a feel for the organization. We've really opened up the opportunity to people get involved. And then as you go to the event or you go to one of these pop-up events, you start to talk to Brad or myself or somebody else, and talk about what is it that you're trying to accomplish, and maybe we can put you on a committee. The committees, I find, are also great ways of just connecting with other people in the industry. It's not just over a beer, but you're actually accomplishing something together. I was involved in the budget committee. Very mundane, very slow committee, but it was a great opportunity for me to connect with 2 or 3 other lenders out there, and it's just a stronger bond relationship that I have with those people. So,
or if you just like to swing the sticks, you could always shoot me an email.
This is the most golf-centric association out there, by the way. It blows my mind. The amount of golf that was played in Monterey.
Insane. Yep.
collective, probably like 300 holes probably was played.
I think we and Gary with Prideco and Jeff with Valchris. I think they played every single day.
Yeah, and that's the funny part is like Valchris is very involved, and people don't know this, but Valchris is in the top 50 in the country when it comes to volume, and so like they've been in CMA for as long as I've been part of CMA.
And I think a very good point on the volume that they do, and they follow your traditional trustee route.
They do. They have not evolved the model that much. Yeah.
So it's, I mean, we could learn from other shops and other businesses out there. And I think that's what also excites me in connecting with more of the institutional crowd, the DSCR lenders, the high volume fix and flip institutions.
There's ways that they do stuff that we could learn from, and ways that they can learn from us on.
Processes, baby. And it's not always about trying to quadruple your business. And I think that is a byproduct of CMA, but that's not necessarily why someone joins in the beginning. And that's, I think, just a misconception out there, a lack of delivery on the messaging. And some others in CMA will say, hey, no, tell them it's all about networking. Networking is a very important part of it.
Sure.
But it's a byproduct. We're coming to make sure that we're still going to be around in years to come, and we learn from each other. And we're part of an association that actually does have a voice in Sacramento, does have wins, and does have a growing bench of younger lenders that are getting more involved. And it's freaking fun. It's exciting.
I will tell you, it's growing. The the new generation of lenders are coming out. And I'd like to see more of it grow because California is, as Jeff Tesh at RCM puts it, the largest economy in the country. You can't ignore it. And so if you're a lender, you have to lend in California if you're trying to grow. Clients all over the country lend in California. So that's one of the reasons why they should get involved. But at the same time, they're going to get value from, there are other ideas in this sector. And we can play into the other ideas. It's not the end of the world, right? And it also, here's how we can learn how to do these loans better than others.
And if you're an aggregator of these loans, I'm not sure why you wouldn't be there educating the entire organization.
Well, that's the other side of it too, right?
Because there's like, hey, what is your buy box?
Other part of the market that doesn't come, and they can provide a ton of value, both financially, educationally, and just process-wise, but also just like explode the access for a lot of the shops there. Because like, what's funny is that you'll meet folks that have 30, 40 years of mortgage banking, but they don't realize, I didn't know I could translate that experience into this sector. That exists. Like, that's the funny part. Like, absolutely it exists. Welcome Ryan Saylor. Welcome other shops that can come through and educate them as to what they are willing to provide. It's, I think, something that appeals to them. The hard part for them is going to be they have to see the value in it monetarily. And I think that's going to be the hard sell for these bigger shops. They have to make money off these shows. Yeah,
or potentially not become the next case study. So it's opportunity
compliance, right?
And that's the biggest thing. Like in your guys' docs, very clear, you cannot table fund in California.
No.
I'm still surprised how many people table fund in the state of California.
It's very often done, yeah.
And it's not insulated to just a few.
It's so frustrating. Like we've been warning folks about it for decades, but
and it's going to take.
But that goes to a different point, though. Like a lot of folks are kind of at a size and scale or willing to take risk, and it's like, okay, well, that's your risk to take, and there can't be any judgment about that.
No, it's a business decision. But where I'm getting at, the monetary value, right? It comes down on the compliance, because we're all one case study away from
agreed
taking a hit, and that's
you're a CPA, which is why I'm an attorney. So we're both in that mindset. But a lot of these guys, their perspective is more like, all right, Kevin, what's it going to cost me if I get caught? I'm like, oh boy, And so like, but it's okay. I used to get really upset when I say that, but as I get older, I'm like, okay, ultimately this is your call to make.
It's opportunity cost. It's a business decision and what they're looking at. And it's like, am I going to have to change my complete infrastructure and sale?
That's the thing.
And that's, but maybe there's a way to learn on, hey, maybe that shift is not as bad. Or maybe the messaging or delivery to that end borrower is not a big deal.
And we've solved this problem for a lot of like East Coast shops break into the West Coast. They're like, okay, this sucks, but this does solve my problem.
And it's everything's publicly available in the state of California. So
that's also true.
That concurrent note assignment is not fooling anybody on the table funding side of things. So it's, and you're potentially, and I'm not their attorney, this is not legal advice, I'm of the belief if you give title one more thing to record, there's one more thing that could get effed up in the process.
Yeah.
So it's
multiple layers of complication. But okay, so let's talk about looking into the future, because you guys are both, the young crowd of CMA. You have 2 little kids. Your kids are growing.
Mine are a little good. I have a 7-year-old though.
Now we're growing our businesses, right? We're growing in private lending, and the market is totally different from when I first met you boys a long time ago, right? Where do you guys see this association, also industry going to? Because we were talking on the way in today, right? Another securitization just happened. Like this market is so interesting and so
dynamic
and
frothy.
Frothy scares me. Frothy scares me. I'm not scared yet, but that's my perspective. I want to hear your guys' perspective, because you're living in the heavily regulatory landscape. You're also different businesses, right? You're doing both residential and commercial. Like, where do you see the California market headed, and where do you see private lending for you guys headed? When
I first started my business, fix and flip loans were everything
that's where everything was at.
Yeah, And
you guys didn't even do construction loans.
No, there were no construction loans. And I had just done a video for our investors where we kind of have made this like evolution from when we first started, where you could do, fix and flip loans at 60% of purchase, and the borrower would come in with the remaining 40% plus the construction funds. And then
3, baby.
Yeah. And then you're lending on, you're lending the construction funds. So now you're trying to set up a construction draw process that was kind of relatively new. And then, obviously the leverage had gone up. Then you kind of did an evolution into more addition. So, that the old fix or paint and carpet job was
cosmetic,
gone.
Yeah.
So now you're adding to the existing structure, okay? And then accessory dwelling units became big. And that was actually bigger. I had funded a couple of these projects down around San Diego State, where they were building it for student housing. It wasn't accessory dwelling units. It was student housing at the time.
Right.
And then California came in with these new ADU regulations. So now you're effectively doing ground up construction loans at that point. That fix and flip, made an evolution into these ADU construction loans. But what I think the institutional market has done was kind of create some general, I don't want to use stabilization, but some guidelines to how this works. And so I think that has been extremely helpful, and I think that the opportunity still exists, but there becomes a point where, what is the long-term trajectory in this, the opportunity in the fix and flip space now with a potentially slowing market. So I think we're going to go through that transition. For a debt fund like myself, the other transition that we've had to make, and I think a lot of debt funds are having to reevaluate, is looking at other property types that we're going to be lending on, where you're not having to stretch loan-to-value ratios. Maybe you're not having to have so much exposure to construction loans. And so I think, again, that
fascinating. There's another debt fund that was commercial heavy, and they're making a transition into residential, which is fascinating.
Well, and maybe you're going to have to be open-minded to that. You have to kind of look at all property types at this point to, make sure that.
But it's also kind of
deploy capital, because
I remember when most private lenders in California did a little bit of everything. Yeah, and so they did commercial, they did resi, the occasional cannabis loan. They'll kind of mix the bag up a little bit, and it seems like that's where we're headed again.
Be. I mean, again, from a private lending space, you got to be open-minded. Your credit box has to be relatively open. You have to find the opportunity there and be able to structure a loan around that. I think that is conventional private lending.
So yeah,
I have a lot to say about this. Get a bourbon after it. So. Not doom and gloom, but in the 1 to 4 space, if the California Association of Realtors actually does a decent job at posting historical data. You could go all the way back to the Great Recession and look at certain data points, days on market, median sales price for properties throughout the state. Download it in Excel and see where it's at. Market's been trading relatively flat the last 12 months, pulling back in some pockets. We've seen some markets 5 to 10% pullbacks from the highs. I have said many times that all the market needs to do is trade flat at certain leverage being offered for the pain on the books to start increasing. I don't know what level of pain hurts, but if you're pushing, and this is just math, this is just basic math. If you're pushing potentially, and this is not anyone's potential loan structure, 75, 80% ARV. I saw an 80% ARV market once.
80 ARV is no longer uncommon. It's pretty common, actually.
Which is insane. So if you talk to someone in 2012 or 2013,
no one touched it.
But if you shared the leverage and pricing being offered today, they would say that there's no way that's happening. But you do your appraisals market pullback 5%. Mm-hmm. Your appraisals off by 5%, which is it's within the margin of error on that. Now you have your agent commissions on the back end, 5 to 6%. You have a 5% buffer. You're not really factoring in holding costs, closing costs, overruns on the rehab budget. So it's not, we talked about this the other week, it's not necessarily that project's finished and can't sell and that seller's got to come up with cash to close that sale. At what point of the process, with very little skin in the game, do they realize they have a loser on the books and walk from it? And now you have wind blowing through the properties.
Right.
So I think in the next 12 to 18 months, we're going to have a repricing and rebalancing of leverage and pricing being offered. You look at certain leverage and pricing being offered on fix and flip loans right now, 95% loan to cost comes out to 130% of the purchase price, 75, 80% ARV. Mm-hmm. I could confidently price out a 60% loan to purchase price bridge loan at more attractive pricing than what's being offered.
Which is also why a lot of the NPL shops are licking the chops. They're busy with Texas right now.
Yeah, and so what I've shared. So where I think things are going, I think there's going to be a repricing. I think that the
repricing in the sense of repricing of loans,
and leverage. And I think in 24 months, not everyone that is doing business now is going to be still doing business. There might be
it's a question of how they handle their foreclosures. For sure.
Well, I think there's going to be. Not to jump in, I think that RTL market is maturing in itself. And I think there is going to be a rebalancing on loan-to-value ratios.
If you study the borrower concentration of the high volume, right? Like there's a lot of heavy concentration on these really experienced flippers. And they get pricing like no one believes, right?
And it's not marketed. And it's fabulous.
It's not public, right? But it's fabulous risk for sure. But like they're willing to buy that risk. It seems like, at least. I don't know how much of that volume translates to the larger RTL sector. It can't be a large segment of it.
You're saying the high volume borrower being a large percentage of the
I don't know that it can't amount to the entire, because that my initial thought was, okay, I know for a fact these big shops are pushing leverage with these guys.
Yeah.
But are they pushing leverage with the masses? And that's the question mark.
And that's, I think, the value coming to CMA and see what deals am I losing out to for a borrower that's got their second one under their belt at 95% loan to cost in the low nines. And so it is being pushed. And I think that shows in the one, velocity of capital. They got to keep it moving, especially with the securitizations that they got. But then also the lack of transactions have come down in the state of California.
Volume's down.
Yeah, volume is down. Margins are continuing to be squeezed, so you have more money chasing a fewer buyer pool on some of these flips, and it's supply and demand of capital.
We had a panel, like Nima and I had a panel, I think about 4 years ago, and the question we asked is fix and flip dead, right? And I was like,
no, it's RTL.
RTL. Well, RTL includes construction loans.
I'm kidding.
But
that's why my joke.
Yeah. It's not a dead market in the sense that there won't be opportunity there. It's just what are you buying in at these properties and how are you structuring the debt? San Diego, I think 65, 70% of the housing stock is over 50 years old.
Yeah, but that's the case in a lot of markets.
I know, but that's why the opportunity exists.
But will San Diego have come to moment like Austin did?
That's where that's the big question. And, we've seen within our own loan portfolio where, days on market after final draw usually was, I don't know, maybe a week, maybe 2 weeks. And you're pushing 30 plus days now.
Yeah.
And so, and that's just a small subsection of what I think generally they're seeing across the board. Now, what does that domino into a higher default ratios? Who knows? These borrowers can maybe hang on, willing to take a haircut off to get out of the loan. We haven't seen it yet. You talk to the servicing agent, big servicing companies, they haven't seen it in California.
Oh, I don't know. Randy's pretty busy right now.
It's coming. And you talk to third-party fund control administrators that are managing rehab funds, things of that sort. So again, this is not a market crash doomsday call. It's just there's a shit ton of money chasing a similar type of product with transactions down. So that's where you see leverage continuously increase while pricing going down. The risk-return profile is slightly skewed, I think, on some of these, even if you're a high-volume borrower. Because it just takes a few to kind of slow things out. Liquidity crunches do happen. And if you're unable to sell some properties, it could create a little rift. But I will say there are a shit ton of borrowers out there looking to acquire the next investment property. I think a very good opportunity in the next 18 months are going to be buying these broken ADU deals. You have value-add investors that are not doing these to hold them long-term for cash flow. They're trying to put on 2 or 3 ADUs to then sell it for a profit. I've seen a lot of refinance requests already hit my desk. Lenders, I think, it's not getting bold. They're going to just start realizing, I need to call these loans due just because the longer I drag it out.
Well, that's been happening for years now. I think lenders are having to do that. They have no choice.
But I think it's going to start coming quickly. And I think which is tricky on the institutional crowd where it's when they sell off the paper and someone's holding it, that holder of the paper is putting reliance on that loan servicer. And they're filing the NOD 6 months too late. And we've seen some to where I think it comes to them being educated a little bit more on that the F word, the foreclosure, NOD is not necessarily a negative thing from a lender's perspective. That protects your investment.
Yeah, I mean, you have to understand the California nuance too, right?
Yeah.
As 1075.
And that's where it gets tricky. And
the other interesting point is if you were to look at our takeout. So we always track, okay, how did we get taken out? A sale or a refinance? I bet you 50% of the takeouts on our fix and flip loans have been refinances into non-QM loans.
I think Nima probably has that data. The question is how much of that goes into the DSCR refi, how much that goes into non-QM refi, how much it goes into just cash buy. What does that go to, right? What's funny though is that at the same time, new builds that are actually happening, at least in my little Orange County bubble, are selling out. It's the most fascinating thing. And they're not expensive homes. Well, they're expensive for the national market numbers, but like for California, they're not expensive homes. They're starter homes. And they're selling.
And that's where I think rehabbers and the capital providers funding the loans need to look in that local market to see, are there any new builds coming to market? Because now my 1 point...
they're not factoring that in?
Well, I've seen it in some pockets. We've told some borrowers, hey, we're going to give you the leverage, but keep an eye on this because you have these new builds that are going to be trading at $950,000 and you're going to try and sell a remodeled home for $975,000.
Yeah.
There's not going to be a yard on the new build, but it's new construction. Yeah. So you're going to see, and we've seen some flips not get highest and best in some pockets as these new builds come to market because the builders need to get them off. And if I could get a brand new build for $950,000 or a fix and flip,
really favorable financing too because they get the best rates.
No, exactly. Or this for $950,000, I might go with that new build, especially holding all things constant. And that's something that we've seen.
I think it's also a price point. So if you look at San Diego market where we're more heavily concentrated, stuff sub 1 million is still moving.
Oh yeah.
If you're north of $1 million, it's a little it's
slower.
Orange County, anything north of
thesis,
2 million,
but it's just 2 million. Yeah. That's kind of the thesis. Like if it's sub 2 million, it's going to move fast. If it's over $2 million property, it's going to take a long time. Yeah. But still, they're moving.
Well, let's talk. I just looked at the 10-year Treasury. I mean, we just dropped sub 4%, and how's that going to impact the housing market? Any thoughts on that?
I mean, I never correlate directly. I don't believe in correlation directly, but DSCR is directly correlated to it. So I think DSCR is going to continue to make headway into California. Ryan told us in Monterey that California is his biggest market. Now they're a smaller DSCR provider. I think that's another thing that CMA needs to understand. Like DSCR is here to stay, guys. Not going away.
Oh, he's coming back.
Yeah, and he should.
Oh, we're actually going to be doing a panel on DSCR. Nima's going to be on it, Ryan, and then we're going to get, now to put all you guys on notice, Dylan Freeman's going to be on there as well. But just from the originator, boots on the ground. How do I handle these objections with certain borrowers?
He underwrites it really well.
Yeah. So
that's the thing is like that, but that's the future. It seems like is that reliance on DSCR is going to have to be the move. So your builders are going to have to understand. You're probably going to have to become a renter, a landlord.
Well, I also think that DSCR product allows us as a bridge lender to more confidently underwrite to what takeout financing would be. To where it's, if you're telling me you're going to underwrite to a DSCR loan, but you're also requesting a 77% ARV loan, that shit doesn't pencil.
And what's the cap rate in your market?
I'm just saying. But you're laughing because it's comical, but it's also true. And
you can't take it out then.
But I think that helps on the underwrite on the front end. But I think in the future, to your initial question, the future in the California private lending or bridge space, it was here way before any of us, and it's going to be here long after any of us. I think think there's
going to be more more people doing consumer bridge?
There's going to be more consumer bridge.
I keep seeing this a lot more. Everyone keeps asking about it. And I keep telling them,
Consumer bridge. And then also...
Like what Shafiq does.
Yeah. But then also, there's a couple other good shops out there. But also in that debt fund model, offering that consumer bridge.
That's the key for our audience to understand.
Yeah, so
you cannot rely on the secondary market for this product.
No, but but you're raising capital and you get the referral sources from going. It's the velocity of capital. You keep it working on because they're like 1 to 3 month holds on them. You're not going to be putting that with your private.
You're talking about A to B. We're selling one property and moving into another property.
Effectively cross them both at times.
It seems to me that like at least in California, and I'm hearing the same story in Florida. This is becoming a more popular idea because it's the same business model for them. That's adding the layer of consumer compliance, which is not the end of the world. So like, and it's an opportunity. If you're a balance sheet lender, you cannot rely on the secondary market for consumer bridge. It doesn't exist.
No, and I think it goes down to knowing what's in the marketplace and learning. And talking from other lenders or what they're doing to drive volume. Because hey, maybe your fix and flip's going down, but you're able to offer consumer bridge.
They get asked for it. I'm sure they get asked for it.
Well, it's I refer it out all the time. And it's again getting into the licenses. We don't carry an NMLS. We don't need one. But it's hey, are we going to add one going forward?
Maybe,
probably, because this is a good deal flow. But then also on the commercial side, if you could close sub 10 days, no appraisal, non-recourse, no due diligence deposit on your commercial stuff, you'll stay busy. There'll be options for you.
Oh, that's another thing. I mean, we were at CMBA CREF together, and I don't know about you, but I felt like the energy in the room was back, and I felt like, oh, commercial bridge is back. The demand is back. The brokers were busy. They were running around, taking meetings all day. Our friends at SLAT were telling us volume's up right now. So our audience needs to understand, like, hey, I know you don't touch commercial, but I mean, whether or not you choose to touch consumer or not, it's your call to make. But commercial, you're already set up for it.
You're set up for it, and it's math, and it's not calculus. It's what's my leverage, what's my return, and what's the exit. Is my risk return profile?
Well, that was the complaint. There's no exit. The banks are dead. That was the complaint. Are they?
I wouldn't say that's the case anymore.
Okay.
You know, there was a great podcast that I had listened to. We were just talking about Green Street. Had a great podcast, and they were talking about, banks are back. The big differential, though, the banks are back, not lending to borrowers per se, but lending to debt funds.
Oh, yeah.
And that is where they're filling that void of.
So someone else is going to fund that perm loan, and they're going to finance it. Okay, that makes sense.
But then on the takeout, they are lending. Takeout's there, but you're not underwriting that to 65 or 70% stabilized value. And there's great data sources out there to underwrite commercial deals where they kind of hoard the data. A lot of appraisers use to get comfortable with it. But am I going to do a 95% loan to cost loan at 8.5%, or am I going to do a 60% loan to purchase price at 9.25% or 8.99? I'm doing the 60% loan to purchase price, and there's opportunity there to weather certain storms. And it's not, to your point, the infrastructure's there, the resources there to do it. It's
funny because like what people don't understand is that a lot of the household names in private lending all do bigger multifamily deals. They just don't do it institutionally. They just do it on their own. And that's no different than commercial real estate. It's actually harder to underwrite multifamily than it is commercial real estate, in my opinion. I remember underwriting them. I was like, this is a lot harder because I've got 50 single, I got to deal with every single one, right? As opposed to retail center, I've got 20 or 10 and I got an anchor. It's easier. So like underwriting is the same skill set you have. If you truly understand underwriting, you can do it. But your people that you look up to or you're brokering loans to are already doing it. So why not do it yourself? And I think that's a lot of people are like, oh, I'm scared of it. Like, look,
send it over.
That's important too, right? Knowing where to send it. So future for CMA. Let's talk about that real quick, and then we'll close on that. Like the future, the next 5 years for CMA. What do you guys envision for CMA in the next 5 years?
I expect to see the trajectory we're on to continue going. Shafiq did a great job at bringing CMA back to the basics on the pillars I've already hammered home. I think there's a drive to education and compliance, as well as advocacy up in Sacramento. So I do expect membership to continue to grow. I do envision some of our institutional friends to get more involved because there will be a time when something on the compliance or legislative side impacts their portfolio. And it's getting ahead of that.
I thought they would come out when that for S1079 came out, but they didn't.
But then you also look at, it's not me reaching out, extending a hand. Let's talk
true.
shop. Let's have a conversation. And that's really where it's at. It starts having a conversation. I do think we're going to see more debt funds continue to be added. And I think the relationship between the debt fund and then loan aggregator to provide potential liquidity, that conversation is going to continue to happen and accelerate.
I see it, yeah.
So,
I think there's a lot of fresh blood that's coming in. A lot of younger individuals that are coming in wanting to learn about the private debt space because it is growing, and there's a ton of opportunity to be in this place. So not only bringing more some of the institutional guys coming in, and not just from advocacy. I mean, it's huge for advocacy, but if you're not marketing to this newer individual that's coming in, I mean, you're doing yourself a disservice.
Yeah.
And so I think our reaching out to the institutional groups to come in and get more involved, it will continue to drive the growth of.
There is a subset of our industry. It's kind of like the new novel entry. It's funding with his own money, kind of hobbyist lender that's wants to grow it.
Brokerage houses starting to create their own debt funds.
Yes.
And just had a lunch the other day.
A lot of clients that are brokers.
2 days ago with a debt fund, with a brokerage that had their own debt fund.
Yep. Mm-hmm.
So that's becoming more popular.
Yeah, I mean, if you're a big brokerage, you might as well have a platform for your own
loans. I think
loans.
that's the natural trajectory. You look at on the fix and flip side, you have a lot of residential real estate agents and brokers that now take deals down themselves and are high volume rehab. Yep. And I think you see that as well on the mortgage broker side, where they just brokered everything out and they're like, well, shit, I could do this too. Mm-hmm. I'm generating the deal. I could raise the capital. I could set it up properly. And I think you're going to see that continued growth.
I like it. Well, we here at Fortra are here to support CMA for as long as you guys will have us. And
Fortra, thank you very much for your support
we love
too.
CMA,
and Kevin, thank you for being involved.
I personally love the events and I love being part of it. Also, I have so many friends there now, so it's awesome. But like being involved has been one of the more rewarding parts of being an attorney, because like you're actually seeing what you advise happen, and so it's really. And now we get to talk to the DRE commissioner, so that's pretty cool. So yeah, I mean, I think that's a great way to close the interview today. For our audience, thank you for listening. If you are a California lender or broker or just California curious, reach out to these guys and get involved, because the California Mortgage Association is really important to our landscape in private lending here in the state of California. This is all for Kevin Kim on Lender Lounge, and we'll see you on the next one. Hopefully we'll be back in here. If you're listening in and watching on YouTube, you'll notice this is not our usual setup. So hopefully we'll be back here next time. Thank you very much for listening. This is Kevin Kim signing off. Subscribe to Lender Lounge on your favorite podcast platform and visit our website, fortralaw.com, to learn more about how we can help you scale.